Hello and welcome to this short seminar about preparing for the next financial crisis. This is part of an emergency preparedness fair presented by the Church of Jesus Christ of Latter-day Saints, the Antioch stake, in August of 2021. To begin with, I'd like to quote Harry S. Truman, who said, "It's a recession when your neighbor loses his job. It's a depression when you lose your own." The purpose of this workshop is to stress what you can do personally to prepare for the next financial crisis, whether that be a personal crisis or a crisis within your household or community, or even nationwide or worldwide. The emphasis is on what you can do yourself and what you can do within your household, steps you can take to shield yourself from financial crisis. The contents begin with a discussion of the scope of the presentation. Then we'll talk about two bases for financial stability that are very important no matter what you're trying to do, no matter whose program you're following. Finally, we'll get to some nitty-gritty details about tracking income and expenses, creating a plan, and then how you can protect your family from hardship in some specific ways. We'll talk about debt, managing a financial crisis, and then there are some bonus sections at the end, which I'll probably touch very lightly on. Many of you have heard this quote, "Grant me the serenity to accept the things I cannot change, courage to change the things I can, and wisdom to know the difference." The emphasis of this presentation, as I said, is on personal finance and what you can do personally. So we're not going to talk about stashing money in your backyard underground in a chest with gold bars. We're going to talk about some really practical things that everyone should be doing anyway, regardless of whether you expect a huge financial crisis. Because the truth is, most of us in our lifetimes will face some sort of financial crisis, even if it's just on a personal level. Those are the things that we'll talk about. Personally preparing for financial crisis is a shield or a hedge against larger economic crisis. So if the whole country were to go into a depression, your personal finances would be a good way for you to prepare and protect yourself from what might happen on a larger scale. Before I get into the specifics of personal finance, I want to talk about two things that I've noticed over the years as I've counseled people and as I've myself tried to implement these tools. Two things that are absolutely required to make personal finance and financial preparation work. These two things are not actually spoken about all that often. It's often just assumed that they exist. So let's talk first about unity, if you will. Unity means that you probably live in a household with someone else, whether it's a roommate or a spouse, maybe children, extended family. But the people with whom you share your financial resources have to be somewhat unified, and ideally totally unified, with what you're trying to do. If they're not on board, it can really make it difficult, if not impossible, for you to do these simple steps. So for example, if you're trying to track your expenses and most of your money is spent on a day-to-day basis by your spouse, then they really need to be on board and willing to do it in order for it to all work. Now, on the other hand, if you have children and you buy them a gift now and then and help them out now and then, but they've really moved on and they live on their own and they're independent, well, then in that case, of course, it doesn't matter as much because you are in control of your spending and your own finances, and they're in control of their own spending and finances. So that's the first thing. There has to be some level or degree of unity. And even if it's not perfect unity, it's still very helpful. I can tell you in my case, I manage my finances very carefully. I track every expense. I track my income. I track it over time. On the other hand, my wife does something similar, but she does it separately from me, and we share our notes and we share our findings. So she receives a lump sum portion of my salary. I receive a lump sum portion of it, and we each individually do these things. But we're not, looking over each other's shoulder to see if someone bought a pack of gum yesterday. That's the first thing. The second thing that's really necessary is that we understand this idea of honesty, and I've represented honesty with the word bias here. Bias means some deviation between what you say or record versus what the truth is. And we all have a tendency to underestimate our expenses and overestimate our current income, and even overestimate our future income. Sometimes we'll get a windfall, and then we start thinking, well, I'm probably going to get another windfall next year too. It's not necessarily true. Things like bonuses are, at best they're the same every year, but in most cases they vary. In my mind, when I know that I'm going to receive a windfall, one of my biggest mistakes is I start spending it in my head. I think of things that I could buy. I think of ways that I could spend it. And frankly, I end up spending it mentally many times over before I actually receive it. And sometimes that gets me into trouble because I've already committed either to someone else or to myself that I'm going to spend that money, and it really is not present. It's not what I think it's going to be. Or perhaps I've told myself that I'm going to receive some sum of money, but I'm looking at the gross amount, not the net amount after taxes. So these are places where we really need to be honest and a little bit meticulous. Otherwise, it's very difficult to manage your personal finances. So for example, if half your income goes into a fund that you simply note as miscellaneous, that's going to be a big problem. And I've actually seen people do that, where a huge portion of their income is just spent on what they call miscellaneous things. That's not going to work. You need a little bit more detail than that. Now, in my own case, a certain portion of my income, and it's probably less than 1% or about 1%, does go into a miscellaneous category. But that's for things like a Slurpee at 7-Eleven. It's for nothing big and nothing recurring. Anyway, so with those thoughts in mind, let's get into the details. The first thing that everyone should do when trying to take control of your personal finances is track your income and expenses, and especially expenses. Most people are pretty good at tracking income. That's because it's fun and exciting to track income, but maybe not so good at tracking expenses. About 4 years ago, I took a course called Personal Finance for Self-Reliance, and I began tracking my spending. I actually don't track my income because I anticipate it, but I guess I do track it, but really what I'm focused on is the expenses because that's what I can control a little better. It's hard for me to just go to my company and say, I'd like to get paid 10% more this month. Whereas with expenses, I can cut my expenses by a few percent through my efforts. So far I've tracked about 2,500 transactions, and I do it in Microsoft Excel. There are other software applications that will do this. One that people really like is called Mint, which does it somewhat automatically for you. So however you do it, you could do it with a piece of paper and a crayon, but track your expenses. I also keep track of my credit card spending to the degree that when I receive my credit card statement, I categorize all those transactions. One in particular that's been a little challenging for me is things that I purchase on Amazon.com, because they show up on my credit card statement as an Amazon purchase, and a month later I've forgotten what it was. So I've started keeping notes, just handwritten notes, whenever I purchase something on Amazon, so that I can keep track of what it was I wanted and I bought and what category it goes into. I'll say that the categories I use come and go. Sometimes I combine categories. For example, I might want to look at all my automobile-related expenses together or all my utilities together. And sometimes I'll break them out into separate categories. So I might want to look at how much I spend on gasoline versus insurance versus car repairs. Or I might want to look at what I spend on different utilities, because some of those things are within my power to manipulate a little bit, or I shouldn't say manipulate, alter a little bit. Manipulate sounds like I'm doing a bad thing, but alter. So for example, I could say, you know what, we're going to turn the thermostat up or down or whichever way it goes to save us a little money, or we're going to make a concerted effort to save water and save some money there. But there are things that I can do to change those categories. So sometimes I combine them to get the big picture. Sometimes I break it down to see specifically what I need to do. In my case, my banking, my credit card do provide categories for me, and that's helpful, but I find that they're not the categories that I really want. So I have to go change them. So a good example of that is someone buys something at the gas station and it shows up as, a charge from Chevron, but we're not really sure if it's gasoline or food or what kind of, maybe it's not food, maybe it's motor oil. So I use my own categories. And as I mentioned earlier, I don't track my wife's spending. She does that herself. And that's the system that we've worked out, and it works well for us. You work out whatever system works well for you. The key, though, is you do need some degree of cooperation from the other people in your household. Otherwise, it's very frustrating to do this. And one of my takeaways from all this is that my car cost a lot more than I thought it did when I started adding up all the expenses. So here's an example of the results of tracking expenses. And these are, mostly these are the categories that I actually use. This is actually my own spreadsheet. This is what's called the pivot table, which summarizes categories by category and by month. I've changed the numbers, the dollar amounts, just to sort of protect my own privacy. But you can see that there are some things I don't spend money on every month. For example, auto insurance, that's the third row down. I make those payments once or twice a year, and usually it's for 6 months at a time. But I still track it by month. And in the end, I still take the total, which in this case is about $4,000, and I divide it by 12 to get an idea of my monthly spending on automobile insurance. And yeah, I do spend a lot on auto insurance. I've got a lot of kids and a lot of cars. Other things that you might notice is some expenses, like say home maintenance, will go along and be almost nothing for some months. $31 for January, but then the next month it's $507, and then it drops to $24, and then it goes on until May when it jumps to $797. And I can tell you, for home maintenance, there have been months when it jumped to $5,000 or $10,000 because that was the month we had to replace our whole HVAC system. One of the things I've learned, though, is that if you track home maintenance and auto repairs, for that matter too, if you track them over a year or 2 or 3, you'll find that it actually is a fairly stable average. So in my case, for home maintenance, it works out to a couple $100 a month on average. And even in those months when I only spend, say, $7, like in September, I know that on average, I'm going to spend $300 because, in the next month, the HVAC is going to break or something bad is going to happen, the roof is going to leak. So that was one of my big takeaways, is track it every month and then start averaging it, and that'll give you an idea what your real costs are. The same can be said, I think, to a large degree for automobile repairs and maybe even medical expenses. They can tend to come in huge sums, and then some time will go by with nothing at all. Right, so there was a lot here. I learned a lot. I continue to track my expenses and my income, but whatever I do, I divide the totals for the year by 12 so that I'm looking at apples and apples when I'm comparing costs of things. Even though my insurance for my car is only paid once every 6 months, I divide it by 12 because I want to know on average what's it cost me per month to insure my car. Right. Now, I could probably go on and on with this for a long time, but it would be, I think, less and less interesting to you because these are insights that I made myself looking at it. Oh, here's one more insight, and then I'll leave it alone. Activities and entertainment. You're going to see my budget in a second, and you'll see that what I've actually budgeted for activities and entertainment is something like, I don't know, it's $100 or something, maybe even $50. It's not very much. And that's really me being a little dishonest with myself and being in denial about what I spend. You'll see that what I actually spend is hundreds of dollars in many months. And that's because sometimes I go to a concert, or sometimes I do something extravagant. And I actually am spending a lot more on activities and entertainment than I thought I was. That did not become clear until I tracked it over about a year or 2. Once you have at least a month's worth of data tracking your expenses, I'd say then is a good time to try to make a budget or a plan. Now, you can do it the other way around too. You can start with a plan or budget and decide what you think you're going to spend, what you hope to spend, but you'll likely come back after a month or 2 of tracking your expenses and alter that budget to show what you actually are spending. So yeah, you can kind of start with a budget or start with tracking expenses. Either way, you can start with both at the same time. My experience has been, though, my budget is impacted in a big way once I start tracking my expenses. So here you go. Activities and entertainment. My original budget, I had budgeted $28 a month. And I think if you actually go back and look at activities and entertainment, you see I spent almost $1,800 over the year. So what's that? About $150 a month is what I actually spent. And my first crack at a budget, I was thinking it's going to be, it's about $28 a month. I don't even know where I came up with that. I think I came up with, actually, I don't know where I came up with that number, but it's an odd number, but I was lying to myself because it's not what I actually spent. You'll also see that there are expenses here that vary a lot with time. And I'm going to call out all the things that I learned from looking at this briefly here. One of them is that activities expenses. Another thing that I'll call out is gasoline expense, which really varies depending on the price of gasoline. So that's one to keep an eye on. Home maintenance, as I said, I average $300 a month, but I think in a typical month, I probably spend more like $50. So that goes into the statistical idea of median versus mean. Yeah, even though most months I spend about $50, in the months that I do spend more, I spend a lot more. So it drags the average or the mean way, way up. And that's what's going on there with home maintenance. That was one of those aha moments when I saw that. You'll see some utilities are more or less fixed. We're going to talk about fixed versus variable expenses in a page here. But things like water, sewer, trash. Right? Okay, I kind of have to have my trash taken out. I guess I don't have to, but I like having my trash taken out. I like being able to flush stuff down the toilet. And I do use some water. Now, I can cut back a little bit on water, but for the most part, everyone in my household is going to shower every day, and we're going to do dishes, and we're going to drink some. And so water is a little bit hard to change, and I sort of consider that a fixed expense. On the other hand, Netflix, that's purely fun, and perhaps I should count Netflix under activities and entertainment. But my feeling was if I put Netflix under activities and entertainment, I will lose sight of it. I forget about it. So by putting it down here as its own category, it helps me keep an eye on it. And that's why it's there. You'll see I spent a lot on cars. I think this is probably true for a lot of people. This is without even a car payment. But when you add up gasoline, insurance, maintenance, parking, registration, it's 11% of my net income. So a big chunk of it. And also, last thing, you'll see some things here that are broken out by month, even though I actually spend it's an annual cost. So my umbrella insurance policy is an example of that. $312 a year, but roughly it's $26 a month. The thing I like about doing that is it reminds me that I'm spending about $1 a day, right? There's 30, 31 days in a month, $26 a month. There's roughly $1 a day that I spend on this insurance policy. It helps me to get a grasp on what it really costs me and whether it's worth it to me, right? Because frankly, you don't have to have an umbrella insurance policy. I choose to. So, it's a way I protect myself. We're going to talk about insurance later too, but it's not absolutely required. It's not like water. All right, once you've got a budget and you've tracked some expenses to see if that budget is accurate, you can start dividing up your expenses into two broad categories. And let me just say, there are other ways of looking at expenses. There are other ways of categorizing them. But the most common way is to divide those expenses up into fixed expenses versus variable expenses. Fixed expenses are things that are not directly controlled by your spending habits. So you can't just say, hey, I'm not going to pay my mortgage this month or my rent this month. I'll pay it next month. There are consequences to that, and they could be dire consequences. That's more or less fixed. There are some things that can be changed in the longer run. So even though maybe your rent is a fixed expense, in the long run, you could move to a less expensive location. So there's a time element to variable versus fixed. On the other hand, there are things like variable expenses that can be controlled by your spending habits. So things like dining and entertainment, that can be controlled much more or less right away. I can decide I'm not going out to dinner from now on until I get a handle on my expenses. That's a variable expense. I can take control of it right now. There are also variable expenses that vary from month to month, but it's hard to control with spending habits. So an example of that would be utilities. Another one would be that home maintenance that I mentioned, or car maintenance, auto maintenance, right? So there are some months when you don't do anything to your car, It doesn't cost you anything but gasoline. And then there are other months where you need a new set of tires and front end alignment, and that's going to cost you, $1,000. So those are variable expenses. But in general, variable expenses are within our control. There's an element of them that can be controlled in the short term, so you can do something about it. I just want to stress, though, the whole lesson of this personal finance seminar is that there are things you can control, and by controlling them, you can ensure yourself a better, more stable financial situation, so that if there is a crisis, you have some stability. In that sense, you can control both fixed and variable expenses. The main difference, as I see it, is fixed expenses take a long time to control, whereas variable expenses, you can usually do something pretty quickly to change that. And now, in my experience counseling people, it's been interesting to note that if someone has a financial crisis, they're often willing to change their variable expenses in order to get out of that financial crisis, but they're less willing to change their fixed expenses. So maybe someone loses a job and for a month they don't have income. Well, they really scramble to come up with some money, but then they get a job and they sort of abandon this financial planning and preparation. What they really probably should have done is, if they're living that close to the edge, they should have found a less expensive place to live, or maybe a less expensive car in situation, or there are things that are bigger chunks of your income that take longer to rearrange, but it's possible. Anyway, so there's a way of looking at it. And remember, the way we're looking at the reason we're looking at fixed versus variable is so that you can decide where you can make changes and how soon you can make changes. And this goes back to that idea of honesty and courage, right? You have to have the courage to make a choice and stick with it. And you have to be honest about whether you can really afford something or not. When it comes to protecting your family from hardship, there are some specific things that you can do. And these are not my ideas. These are just commonly held, I don't want to say beliefs, but this is common good advice. So one of the things is develop a 1-month emergency fund. That's the first thing you can do. Later we'll talk about extending that to more months, but for 1 month, you should have enough cash on hand, something very liquid that you can use if there's an emergency. So if the car breaks down, or if you do lose a job, or if you do need HVAC in August, what do you do about that? There are a couple different ways of doing this. Some people keep that money in the bank because it kind of keeps it, just a little bit out of touch. You can still get to it. It's pretty liquid, but it's a little bit sealed and kept away from it keeps you from temptation. The other way some people do it, and I've done this, I actually do a combination of both these things, is I keep that cash in an envelope sealed up, but in my 72-hour kit. And that way, if I had to leave my home suddenly, I could grab this big box of food and flashlights and blankets, and there would be some cash in there that I could use along the way. I do a combination of both, but I would say the things not to do, keeping your money in gold probably is not what we're talking about here. If you want to invest in gold, that's fine. That comes later with investments. But keep this in currency that you can exchange for a gallon of gas or some food or something that you need, a home repair, right? The other thing is, do not consider your credit card to be your emergency fund. So I used to do this. I used to think, well, hey, I got this credit card and the limit is $10,000. So if anything really did go wrong, I could live on my credit card for a month. That's not what we're talking about. We're talking about cash. In order to get that cash, you'll need to start changing your spending habits so that you have a little extra cash every day, every week, every month that you can start putting into this 1-month emergency fund. And changing your spending habit goes back to those fixed and variable expenses and understanding where your money really does go. And if you value where that money goes. I mean, if it's something you really, really value and you're willing to pay for it and you're willing to give up other things to do that, then that's your prerogative. So maybe you really like vacationing in Europe. And in order to vacation in Europe, you are willing to live in the lowest cost house and drive the lowest cost car and never go to any movies. And if that's what it takes to get you to Europe and it's valuable to you, then that's your choice. Do that. The second thing, though, that you can do, aside from this 1-month emergency fund to protect your family and your household from hardship, is to pay down consumer debt. We'll talk a little bit more about this in a page, but basically it's decreasing your spending a little bit so you have some extra cash and applying that extra cash now to your consumer debt. So credit cards, car loans, home equity lines of credit, or whatever else you've borrowed money for, pawn shop, but paying down consumer debt with a little bit of money. The key to making all this work is you need to free up some cash so you can start to build a 1-month emergency fund, or free up some cash so you can start to pay down your consumer debt. And in order to free up cash, you probably need to change your spending habits, and you probably need to change some of those longer term expenses. The third thing you can do to protect your family is have insurance. And so I'm not an insurance agent. I'm not even a financial advisor, but I do know that there are some basic, levers that are negotiable when it comes to insurance. So one is what your deductible is. Maybe your automobile deductible is $500, which means if you wreck your car, at most you're going to pay $500 to get it fixed. But in return for that, the insurance company wants a little bit more in terms of premium. Maybe you have an older car. Maybe you could live with a $1,000 deductible because you have a lot of money in your 1-month emergency fund, and you figure if I wreck my car, it costs me $1,000, but I have $1,000. Or maybe, like I said, you have an older car and you don't need full coverage. You need insurance coverage to drive your car, but maybe your 20-year-old car doesn't really need all the insurance it has. And you can take on a little bit of risk by saying, if I wreck that car, well, it was a good car and it served me well, but take it to the junkyard, that's the end of it. So that's one thing, looking at your insurance needs, and that could be life insurance, could be home insurance, could be renter's insurance, could be automobile insurance. The second thing is, when it comes to life insurance, there are two broad categories of life insurance: whole versus term life insurance. Term life insurance is probably the simplest, meaning if something bad happens, your family would be compensated. Whole life insurance does that, but it also serves as a type of investment. So look into that, find out what kind you have or need. In general, investing your money comes later after you've taken care of some of these more basic things, right? So actually investing the money would be a second course that follows this workshop. Once you've done those things, then you can begin saving enough money to cover 3 to 6 months of expenses. Now, the beauty of having 3 to 6 months of expenses is you can get hit by a fairly major life event and you can roll with it. So maybe you're out of a job for 3 months. Well, if you have the money to roll with that, you can afford to wait until you get a better job, or get a job that that you want, as opposed to taking a job you don't really want because you just need some money now, and even though they're not going to pay you as much as you'd like, you got to do something. With enough money in savings, say 3 to 6 months, you've got the luxury of making better decisions. And then the last thing I mentioned was investing for the future. There actually is one bullet beyond investing for the future, which would be sharing your wealth with others. And that's also beyond the scope of this course, but it's not a bad idea. Let's take a minute to talk about debt. So I actually work for a bank, and in simple terms, banks earn money 3 ways. So they earn money, if you think about it, through interest, right? If you borrow money from the bank, you have to pay back that money plus interest. That's one way. They also earn money through fees, right? An overdraft fee, for example, or a loan origination fee. That's the second way. And the third way is through capital markets. But let's focus on the first two, interest and fees. And in general, banks want you to have debt, assuming you will pay your interest and fees, because that's their source of income. So they encourage that. But in general, for you as a consumer, debt is not a good thing. It's you paying money for money. You're buying money with money, and the cost of that money can be somewhat high. If you look in the lower right-hand corner, there's an example of the kind of disclaimer that you may have seen on your credit card statement. It tells you how much, if you pay only the minimum, how many years it will take for you to pay off your credit card, and also tells you how much you would have ended up paying. So the assumption here is, let's say I stopped using that credit card today, but it still has a balance. I don't know what the balance is. It's maybe $1,200. I think I cut that part off. Well, if I only make the minimum payment, it will take me 7 years to pay off that. And in total, I will have ended up paying $2,017. So a huge interest expense on top of the principal, which is what I used my credit card to buy in the first place. If I pay a little bit extra, in this case, $44, I can pay that off in 3 years, and it will have only cost me total $1,584. In other words, by paying $44 a month extra, or pay $44 a month, period, I can save myself $433 over the next 3 years. So that's an example of, take a look at your credit card statement. They should all have this kind of statement now. It's required. That tells you how much you're paying in interest. I mean, my goodness, it's like, even in the case of $44, it's probably a third of the credit card balance that's paid interest. Some debt may be acceptable. And I want to be really cautious about this, because sometimes people use these 3 bullets as an excuse to overextend themselves. So a modest, affordable house may be acceptable, or it may make more sense for you to rent. I don't know. You need to look at your situation. But I've seen people use this as an excuse to buy way too much house. They say, well, buying a house is an investment. That's good money. Well, maybe, but if it's more money than you can afford, then it's going to be like a boat anchor around your neck. So a modest, affordable house. Also, reasonable education expenses, assuming that they will lead you to better work. And think about how much better will that work be? How much more will it pay? A good example of this is my son, who's now in physical therapy school, and he's borrowing money to go there. But when he finishes, his earning potential will go up quite a bit. And I don't know what it is, but let's say it goes up $20,000 a year more than he could currently earn with his bachelor's degree. Well, that might be a good investment, right? Because in 7 or 8 years, he can pay off his loans. He's doing something he likes to do. He's earning more money. That's a debt that is acceptable, at least to me. The third one here is modest basic transportation. So don't just say, well, I got to buy a car, so I might as well buy a nice one. At this time, in August of 2021, all cars are very expensive, both new and used. It has to do with supply chain disruptions. If you go try to buy a modest car nowadays, you'll find that it costs many thousands of dollars. And well, sometimes you just need a car because you need to go to work or you need to go places. But be aware that cars in general are a depreciating asset. So whatever you pay for it, whether it's an expensive car or a cheap car, it's probably going to be worth less in the future. Especially if it's a car that you're driving every day. It's going to be worth less in the future than it is today. So you don't want your money sitting there depreciating in your car any more than you have to. Anything else is debt that should be avoided. And I know there are a lot of financial advisors who will say, cut up your credit card because you shouldn't be going into any sort of debt for anything else. Even putting a tank of gas on your credit card is debt, and don't do it. I leave that up to you how you want to do it. I do have one credit card. I use it. I pay it off every month. Seems to work for me. I actually, I limit the kinds of transactions I put on my credit card. So gasoline is one of those things I do put on it. But there are other kinds of transactions that I will use a debit card for example, because I want to see it come out of my checking account right away. When you put things on your credit card, you tend to forget how much stuff is on there, what the balance is till the statement comes. So I have certain expenses that I will purposely use a debit card for, so that immediately it comes out of my checking account. And when I look at my checking account balance and say, hey, what happened to that $100 that was there? I can, it's an immediate feedback for me. There's part of this is an information loop, giving you feedback on how you're spending your money. If I put on a credit card, it could be almost a month before I even am notified what I spent it on. If it's something I bought from Amazon, I don't even know what it was. It just says Amazon, and it's probably not due till 3 weeks after that. So it's really easy to forget and lose track and become disassociated with your purchase and with your money. Whereas using cash or using a debit card, the feedback loop is a lot quicker. You see where it went, you realize it's gone, and it works a little better for a lot of people. If you do have debt, and most people do, so let's just assume we all do, one of the things you really should do is create a debt inventory. And it's really simple. So 4 columns. First column is a description of the debt, right? Is it Chase Bank? Is it Bank of America mortgage? Is it, who is it? Who do you owe the money to? Is it your cousin Vinny? Who do you owe the money to? Second column is the balance. How much do you owe? The principal. Third column is the interest rate, how much you're paying for the privilege of using that money. And the fourth is the monthly payment. So in that case, you've got this chart that has description of the expense, balance, interest rate, monthly payment. Now what do you do with it? Now you take action. Well, first of all, stop incurring new debt. So don't go any further down that rabbit hole. Start building an emergency fund. Quit using your credit cards if it's a temptation for you, but stop incurring new debt. That's the first step. Second step is to pay off your debts. And there's really no magic to this. The key is curb some of your spending to free up a little cash. Use that cash to make extra payments towards your debts. And there are 2 ways of doing this. One method is to sort that table of your debt inventory into interest rate, so that the highest interest rate is the first row in the table, and then apply those extra payments towards the highest interest rate debt. Financially, this makes the most sense, right? It's saving you the most money in the long run. That's a smart thing to do. Mathematically, it makes sense if you're trying to save money. The other way of doing it, which makes more sense psychologically, because we're all humans, is sort that list by balance so that the lowest balance debt is on the top, and apply your extra cash to the lowest balance item first, even if it's only a small amount of extra cash. So, let's say you're only $500 away from paying off your car, and you can free up an extra $100 a month by carefully spending less on other things. Apply that extra $100 to your car. And I know if you do this, I probably picked some wrong numbers, but if you do that, you're probably going to pay your car off rather quickly. So if you only own $500 on it, a month or 2, you're going to pay it off, whatever your payments were. You're going to get a huge rush. There's a psychological benefit when you pay off a debt. You can get a black pen and drag it across that table and draw a line through your debt. Then what you do is you take the money you had been applying towards that debt, right? Both the required payment and also the additional cash, and you roll that over and apply it to the next row in the table. And this is called the rollover method in general. So I'm not going to go have a party because now I got this extra money. I'm going to roll it over to the next debt. And it snowballs, right? Because every time you pay off a debt, now you've freed up even more money to pay off the next debt. And there's a lot of psychological benefit to knocking these out and to taking control. It gives you the feeling that you are in control of your money. And that empowerment encourages you to keep going. So here are some pros and cons of those 2 methods, focusing on high interest rate first or low balance first. As I said, high interest rate makes sense financially because you're eliminating the high interest items, so you'll pay less interest in the future. But low balance also makes sense because you feel like you're winning and you're getting ahead of it and you are in control of it. Assuming you've done all these things, or you're starting to do these things and you are prepared, how do you manage a financial crisis? Well, first thing you can do is increase your emergency preparations. And I mentioned earlier that once you build a 1-month supply of expenses, an emergency supply, start building that up to 2, 3, 4, 5, 6 months of emergency fund. In terms of insurance, you can also start self-insuring, so to speak. So an example of that is, with a car, you could say, I'm going to change my auto insurance policy so that instead of a $500 deductible, I have a $1,000 deductible. Now, the worst that can happen is I wreck my car and it's going to cost me $1,000 to fix it. But if I have $1,000 set aside for things like that, then I can cover it. Or Anyway, so that's an example of adequate insurance. It's possible to be overinsured. I will tell you, recently I dropped one of my insurance policies because it's a policy that I got when I was in my 30s. And when I was in my 30s, I did not have a lot of savings. I had a lot of kids at home. And if something were to happen to me, or would have happened to me in my 30s, if I had died, it would have left my wife with a large burden. So I had a lot of insurance, a lot of life insurance. And recently I started to look through it and I realized, I don't really need that much insurance anymore. I'm still worth more dead than alive to my wife, but 3 of my kids have moved out of the house. They're adults, and I've got a lot of saved now. I've got retirement accounts. So there are other ways that my wife would be just fine. I don't need quite as much insurance. So review your insurance. That's something you should do with an insurance agent, not based on simply what I'm telling you. So go talk to an expert. Assuming that you've done all that and a financial crisis does occur, the way you handle it is basically a 2-step process. First, assess the situation. 2, take action. So assessing the situation is, what do I have in my emergency fund? Do I have food and water? Do I have insurance? Are there any other sources of income I haven't looked into? Can I make further adjustments to my budget? Maybe now's the time I cut my cable because I really can't afford it. So assess the situation. I actually had something like this happen to me. It's not very drastic, but I'll give you the example anyway. I have a health savings account, which allows me to get reimbursed for expenses, health expenses. Earlier in this year, I had a large health expense. It was around $3,000. And I never turned in that receipt, so to speak. So I never got reimbursed from my health savings account for that health cost. Therefore, that money just came out of my checking account. Well, recently I was notified that I am losing my job. I'm being severed because the company is downsizing, reorganizing. Now's a good time for me to go find that receipt and turn it in and get reimbursed that $3,000, because that's money that would really come in handy on top of these other things that I've done to prepare. So that's an example of, looking around, seeing what resources you have, assessing the situation. And then the second step is just taking action, using that emergency fund. Of course, not making any new extravagant expenses, or not even extravagant, unnecessary expenses, really deciding what you need versus what you want. If it really gets bad, call your creditors, maybe work out a different payment plan or a different schedule, and then start identifying other resources that you haven't thought of yet, like family and government. Maybe you're eligible for unemployment insurance. I know, having looked into it this week, unemployment insurance, at least in my area of California, it wouldn't buy you that much, but it's better than nothing. So look into that. Look into family. Church is another option there. Sometimes there's part-time work you can do. I guess you got to weigh the pros and cons of it, though. So here's a bonus topic before we wrap these things up. I've got 2 bonus topics for you. This is actually my cash flow. It's been altered a bit because I didn't want to reveal too much about my actual financial situation. So the numbers have been monkeyed with. They're not real numbers. But as you see, I get a bonus. Used to get a bonus in about June of each year. That's that line about 2/3 of the way across that spikes up. By the way, this graph's probably a little small, so let me explain what it is. The left hand, or the vertical axis, is dollars. And it goes from negative $6,000 at the bottom to positive $15,000 at the top. So that's how much money I have in my account. You'll see a dark horizontal line across the middle. That's 0. So whenever this jagged line dips below the black line, it means I have a negative account balance, or I will have a negative account balance, because this is looking into the future. And one of the issues you see that I'm going to have is, even though on average, if you average this whole jagged line, it averages out to about $4,600. So on average, I got enough money. I'm gonna have $4,600 in the bank. That's a good, safe place, right? But I'm going to be in trouble. And I could be in trouble a couple of ways. One, I'm just going to overdraw my account for a couple months until I get my bonus. 2, if I don't get my bonus, or if it's a lot less than I expected, I'm in trouble because this is trending downwards, right? So I'm really relying on this bonus to bring it back up again so it can continue to trend down. So I got 2 problems here. Even with the bonus, I will overdraw my account at some point. And if I don't get the bonus, it's trending down, I'm going to be in trouble. So Yeah, this is called cash flow analysis. Once you have a good handle on your expenses and on your budget, start looking forward and seeing how that money is going to look over the course of time. So maybe you get paid. So for example, one problem I've run into is, you know, my mortgage gets automatically withdrawn from my account on the 1st of the month, but payday is not until the 5th of the month. Right? So yeah, I will have enough money in 4 more days, but I'm not going to have enough money on the day my mortgage gets subtracted. In the olden days, you used to be able to float a check, right? You could write a check and you knew it would be a few days before that check made its way back to your bank account and they actually took the money out. You really can't count on that nowadays. Transactions are done electronically. And a lot of times, even a check will be immediately converted into an electronic transaction and will happen the same day. So you need to know when something gets paid, when you get paid, and what that's going to look like over time so you can time it. That's cash flow analysis. And you know, cash flow analysis is a little bit more complex than that on a corporate level, but on a personal level, all you want to do is just see how it's going to look over time. I happen to use Microsoft Excel to do this, but I'm sure there are other applications which will work equally as well. I was going to say I'm not endorsing any particular software product, but I guess I am endorsing Microsoft, aren't I? The last sort of bonus topic, I'm really going to try to stay away from this too much, but you need some understanding of income taxes. And I find this is a big problem. I've had people come in and say, wow, I got this huge tax bill. I had no idea it was coming. And yeah, I could see your taxes might be more than you figured. But if your taxes are thousands and thousands of dollars more than you figured, you're probably not planning well enough. So, you know, one way to plan taxes is look what you paid last year and how much you earned last year. Ask yourself if you're going to earn about the same amount this year, and if there have been any major changes in your life. Did you sell a house? Did you buy a house? Have your kids grown older? Things like that. But in general, this is a very rough way of looking at. Actually, I shouldn't say rough. It's a simplified way of looking at taxes, and it just looks at earned income, by the way. But here's how it works. Let's start on the left. It says you have some gross income, some total amount of money that you get. And this kind of assumes that, you know, you're getting a W-2 at the end of the year and there's some gross income. What's reported on your W-2, though, is not that gross income. It's probably over here, they've subtracted some things. So, for example, in my case, they subtract my retirement 401k. They subtract my medical premiums. And instead, there's this amount called an adjusted gross income. That's the part that's actually maybe subject to taxes. But there's one more step. Adjusted gross income gets adjusted again by subtracting deductions. So deductions can generally be one of two kinds. There are itemized deductions where you make a list of everything that's tax deductible, right? So that could be mortgage insurance you paid, charitable donations, and you subtract all those things, those tax deductions from your adjusted gross income to come up with your taxable income. The other way you can do it, which actually makes more sense for more people nowadays because the government has changed the standard deduction, is you just subtract a certain amount. And I'm actually not even sure what it is. I think it's about $25,000 now for married filing jointly. But what that means is I take my adjusted gross income, I subtract $25,000 or so, and then what's left is taxable. The last point I think people don't get is you don't pay the same amount of taxes on all of your income, right? On the first part of your income, right, from the first dollar you earn on January 1st up to some point, you're only paying about 10% federal income tax. And then as you earn more and more, the next part of your income gets taxed at 12%, and the next part at 22%. And what this means is if I were to earn $1 extra on December 31st, you know, everything else being equal, I would pay 22 cents tax on that $1 extra. So I find sometimes people get confused about this. They assume that their entire income is taxed at 22%. No, it's taxed in tiers. This top tier is what they would call your marginal tax rate. So if you earn an extra $1, you're going to pay 22 cents extra tax on that. You can, if you want, you can add up all your total taxes, all the black areas, and you can divide it to come up with something called your effective tax rate. which is sort of interesting, but to me, this marginal tax rate is most interesting to me because it says, let's say that I get a chance to do some extra work. Someone says, I'll pay you $1,000 to do this work for me. I think, well, okay, that's good, $1,000. How much of that's going to be taxes? Well, if this were my situation, about 22% would be taxes. As I said, this is a simplified view. It doesn't take into account things like capital gains tax or self-employment tax and all sorts of other things, but a simplified view of how taxes work, and you should understand it a little bit so that you can make wise decisions. That's the second bonus topic. The last thing I want to mention is once you feel like you've got a good handle on these things, then start thinking about investments and thinking about how you can share this with other people. So thank you very much for joining this workshop, and I wish you luck. I hope you gain some sort of enthusiasm for doing this. Personal finances is a little bit difficult because it's something that you need to keep doing your whole life long. I don't know very many people who have so much money that they can just ignore their personal finances. They might be able to pay someone else to look at it and take care of it for them. But what happens is as we earn more money, we figure out more ways to spend it. So even someone who has an awful lot of money still has to worry about spending it. And as I said, they probably pay someone else to do some of that worrying for them, but it's still an issue. And for you and me and typical people, yeah, we should probably be thinking about it for the rest of our lives. Once you get a handle on it, it's very empowering. You'll feel that you are controlling your money as opposed to your money controlling you. So anyway, thank you very much. I hope you've enjoyed this workshop. My name is Carl Ashcroft, and it's been fun for me as well. And good luck.